Now, how can we think about global competition among these legal and financial advisors? Like we've been talking throughout the previous slides, non-IFC, non-elite advisors have certainly increased their market size over the time period we study. And we see that in figure 21b through the elasticity of advisors' deal sizes with the total for the top 10. So just like the last slide, we were looking at how much these deal sizes changed for the top advisors relative to everyone else. We see that these deal sizes have been shrinking over time. And what we also see is that there is a track of advisors around the world. So it's not the case that geography is this equal plane, this equal playing field. But instead there are geographical locations, which we see in figure 30, which serve as kind of ruts for advisors. If you are an advisor working in one of these jurisdictions, you can move up and down the league tables in terms of the number of deals that you get, the value of the deals that you get. But we find that basically when you're in these jurisdictions, that almost determines, that's almost destiny for these advisors. So when we ask how can we make advisors more competitive, we're usually asking about advisors located in places like the Middle East, like Australia, certainly in China, and to a lesser extent in East and Southeast Asia. And what we find in our econometric analysis is that there are two factors which determine an advisor's competitiveness in these dots that you see on the map. The first, of course, is the quality of the financial law, and second is the extent of service differentiation by these advisors. Now, let me describe briefly what we mean by these factors and why they might contribute to advisors' competitiveness. Now, when you think about legal complexity, of course you're thinking, well, having very complicated financial law, having lots of reporting requirements, having very in-depth supervisory requirements by regulators, that's very costly. How can that possibly be good for M&A transactions? And the answer is, it's that same complexity that allows advisors to structure very complicated deals in order to make even unprofitable deals profitable. Think about the subprime mortgage crisis that occurred in the US and probably will occur in China in the upcoming years. These advisors took non-performing assets, they took mortgages that weren't paying, they were rebundling them and selling them on Wall Street so that investors could make lots of money. Without the financial law underpinning the securitization relationship, there's no way that money could have gotten to these mortgages and eventually help to grow the real estate sector. Now, that example, of course, is a negative example of the power of financial law, but it is illustrative of the way that financial law can be used to structure financial transactions. And I had to choose an example that you were probably familiar with, even though it's a negative example. So what I'm asking you to do at this point is just believe that if the financial crisis represented a small bad part of financial law, there is a very large and very productive part of financial law which is used to structure deals in a way that can add value to both target and acquirer. A London or New York-based advisor, whether bank or law firm, can appear in Beijing and say, look, I can structure your deal in a way that nobody else can, by virtue of the law that my advisory firm inherits. And of course the client's going to say, yes, I want that. You can take a firm which might not be doing so well, merge with another firm, get everything that company wanted in terms of intellectual property flow, in terms of customers, new markets, etc., but also this fabulous, spectacular array of attributes coming from financial law, diversification of risk, partitioning of risk across borders to people who might want it, and so forth. And it's that structuring of the deal that comes through this legal complexity that gives these advisors their value. Now, of course, on the other end of the spectrum, we have advisors looking at this structuring of deals, and they're saying, well, maybe I'm not from a jurisdiction that has that kind of law, or maybe there are other advisors, these big boys we've been talking about, who already have sewn up this market. How can I react? How can I differentiate the type of service that I offer in order to compete with these elite firms? So, taking another example from the pop press, you might think about the nationwides of the world, these securitizers that started to arise in the middle part of the 2000s. They were the differentiators. They were the ones that said, look, we're going to make something completely new, completely different. Or to take another example, fintech. You have some companies that say, look, we cannot compete by size. There's no way that we can use the legal complexity that we've inherited from our jurisdiction. What else can we do to try and earn this business? And what you'll see shortly is that we can actually measure this and see how this differentiation over time has helped certain advisors score mandates.